Welcome back, everyone. Really glad you're here. Let's get into it. So, Bitcoin is sitting at 71K as I'm recording this. If you watched the last video, we were sitting directly on the 200-week EMA at 68K. And I said that was the only level that mattered. Well, it held for now. The fear and greed index is at 14, still extreme fear. Sentiment is still on the floor, and the headlines are still full of war, oil prices, and macro uncertainty. But here's what I want to talk about today, because this is the thing that almost nobody is covering right now. While retail is scared and the price is grinding at these levels, something very specific is happening in the background. Institutions aren't waiting, they're building. And three things happened this week alone that I think are going to look very significant in hindsight. By the end of this video, you will understand exactly what those three developments are, why they matter more than today's price, and what the chart is telling us now that the 200-week held. And the third one, involving two of the biggest financial companies on the planet, honestly surprised me. I will get there, by the way. Let's start with the chart because the picture changed this week. So the 200-week EMA at 68K held as support, at least on a weekly close. That's the most important thing that happened this week. Every time that line has held in Bitcoin's history, the subsequent move has been significantly higher. That doesn't guarantee anything, but it changes the probability calculation. The RSI is starting to recover from the extreme lows we saw earlier this week when it hit readings we haven't seen since FTX. Still not out of oversold territory, but the direction matters. Momentum is beginning to shift. The first real resistance from here is around 75K. Above that, the 200-day EMA at 86K is the biggest target. That's not a straight line. There will be choppiness, there will be tests of 68K again, but the structure is now marginally more constructive than it was 72 hours ago. Could 68K still break? Absolutely. A close below it on a weekly basis is still the risk case, and it takes us towards 63 to 65K. I'm keeping dry powder specifically for that scenario, but right now the line held, and that matters. But here's what I really want to get into, because the price action is only half of the story this week. The other half is what institutions are quietly doing while everyone is watching the price. Quick mention, if you are positioning around levels like 68 to 71K, Bitunix is what I use personally. Simple, clean, gets the job done. Link is in the description, by the way. This is part of the video I've been looking forward to, because while the fear and greed index sits at 14 and retail is scared, three things happened this week that tell a completely different story about where this industry is heading. Tether, the issuer of USDT, the largest stablecoin in the world with a market cap of around $184 billion, announced it's bringing in one of the world's top four accounting firms for its first ever full independent financial audit. We're talking a complete review of assets, reserves, and internal controls. Now, I know what some of you are thinking. This should have happened years ago, and honestly, fair point. But here's why it matters right now. Tether is the plumbing of the entire crypto market. When $184 billion worth of stablecoins get a clean audit from a big four firm, it removes one of the last remaining credibility questions that institutional players use as a reason to stay out. That door just got a lot easier to walk through. Development 2, actively managed crypto ETFs are being built right now. 21 Shares, one of the major crypto ETP issuers, said this week that active management is the next evolution of the crypto ETF space. Active ETFs globally already hold nearly 1.8 trillion in assets. The idea is moving beyond simple buy Bitcoin and hold it products towards sophisticated strategies that actively manage risk and position around market conditions. In plain terms, the institutions building these products aren't looking at the 14 reading on the fear and greed index and thinking the game is over. They are hiring portfolio managers, building infrastructure, and launching new products. You don't do that if you think this market is dying. And development 3, MasterCard and Western Union just joined Solana. This one genuinely surprised me. The Solana Foundation just launched a new enterprise developer platform, and the early users include MasterCard for stablecoin settlement, WorldPay for merchant payments, and Western Union for cross-border payments. These are not crypto-native companies experimenting. These are some of the largest payment infrastructure companies in the world actively building on a public blockchain. And here's the connection back to Bitcoin specifically. Every time real world institutions deepen their integration with crypto infrastructure, whether it's payments, stablecoins, or ETFs, it expands the total addressable demand for the entire asset class. Bitcoin sits at the top of that stack. As the plumbing improves, the destination gets more valuable. Now, here's a number that ties all three of this together, and it puts the fear and greed reading of 14 into a completely different context. Let me give you a number. The fear and greed index has been at or below 20 for 11 consecutive days now. Extended extreme fear readings like this are historically one of the rarest conditions in Bitcoin's market cycle, and they have almost always preceded meaningful recoveries. I'm old enough to remember November 2022, FTX had just collapsed. Everyone thought crypto was finished, the index was pinned in extreme fear for weeks. That was the exact bottom. Not because the news got better overnight, but because eventually the sellers ran out, the structure held. Now, I'm not saying we are at the bottom right now. The macro headwinds are real. The Iran war is still ongoing. Oil is still elevated. The SPF 500 is still under pressure. These things don't resolve on a schedule. But here's what matters. Fear doesn't last forever. And while fear is peaking, the people with real capital and real conviction are not sitting on their hands. They're hiring auditors, they're launching ETF products, they're getting MasterCard to build on their blockchain. That divergence between what retail feels and what institutions do is one of the most reliable signals in the market. The founding rates are still flat to slightly negative, meaning more traders are positioned short than long. That's actually a constructive setup from a contrarian standpoint. When short positioning is this crowded and price holds support, the squeeze potential is real. Before I tell you exactly what I'm doing right now, I want to be honest about the one thing that could still break this setup, because ignoring the risk would be doing you a disservice. When I'm placing trades around key levels like the 200-week EMA, I use BitUnix. Clean platform, simple execution, link is below by the way. Now let me be straight with you about where I stand. The 200-week held, fear is at 14, institutions are building infrastructure at a pace that doesn't match what the price is doing, smart money is quietly positioning, and the supply picture hasn't changed. 21 million coins, roughly 4 million lost forever, and about 70% of the remaining supply unmoved in over a year. I've been adding stage positions between 68k and 71k, small, deliberate, not all in. The plan was always to accumulate at this range if the 200-week held, and it has. I'm not chasing, I'm not going heavy, but I'm also not sitting completely on the sidelines when the chart structure is this specific and the institutional backdrop is this constructive. The risk case is still alive. If 68k breaks on a weekly close, I stop adding and reassess. My dry powder is specifically reserved for the 63k to 65k zone if that happens. I've got a plan for both outcomes. That's the only way to stay calm in market like this. And honestly, the Tether audit, the active ETF infrastructure, MasterCard building on Solana, none of those things are priced on the current sentiment. The market is pricing the war and the fear. It's not pricing what's being built underneath. That disconnect is where opportunities tend to live. Now, base case, 68k holds, fear slowly unwinds, institutional flows return, Bitcoin grinds toward first resistance at 75k, and then the 200-day EMA at 86k. Risk case, macro deteriorates further, 68k breaks on a weekly close, 63 to 65k becomes the conversation. The level 68k is still the only number that matters. We're watching this week by week. Let me know what you're seeing in the comments. Thank you so much for watching, and I will talk to you guys in the next one.